Hi, and thanks for watching. My name is Mike Desepoli from Desepoli Wealth Management, and this is a quarterly market update. The purpose of today's video is to provide a recap of the second quarter as well as our outlook as we move into the third quarter. When we look back at the second quarter and what drove the markets were dominated by many of the same news headlines that we spoke about last quarter in our video, whether it be fluctuation in the interest rates, news coming out of Greece as far as their fiscal situation, news about whether or not we're going to have a nuclear deal with Iran, or even further developments in the oil markets as we've seen oil prices fluctuate all over the place this year. A lot of these headlines and a lot of these news events are some of the things we spoke about last quarter, and we continue to see them being very prevalent in the marketplace. So let's take a look back at the second quarter. For all the volatility that we saw, and we saw markets move all over the place in reaction to these different news events, the end result for the quarter was very muted. The S&P 500 and the Dow Jones Industrial Average, which are two of the larger U.S. benchmark indexes in the United States, each had returns that were negative, 0.5%. Negative returns, but albeit not very much. When we take a look at our portfolios, our focus was in different areas for the second quarter. As we spoke about in our last video, we decided to focus more on small U.S. domestic-based companies that were not going to see a negative impact from the rise in the U.S. dollar, and we're not going to see a negative impact from the decline in oil prices, because these companies we were investing in did not have impacts in their business model from fluctuations in those commodities. And that worked out fairly well for us for the second quarter, as well as continuing our conviction in healthcare. We think there's tremendous opportunities in healthcare. As you know, it's been a part of the portfolio for some time now, and we see it there for a long-term hold in the future. Our portfolio for the quarter returned just over 1%, which has allowed us to maintain our year-to-date lead that we have on the major indexes. We're looking to expand upon that lead as we move into Q3 and Q4, and we do think the markets will pick up in the second half of the year, as we've seen a very tight range on the markets through the first 6 months so far. Greece was something that was all throughout the headlines this quarter. So just a quick, to catch you up on what's happening in Greece. Essentially, Greece has run into financial troubles again for the third time in the last 5 years. The first two previous times they were granted a bailout, a financial bailout from the European Union. And now they're back in line for another bailout, and the European Union wants them to agree to a sweeping set of fiscal changes, a tightening of the belt, if you will, before they'll grant them any more funds to bail them out. Initially, Greece did not seem to want to go along with these suggested changes, but now I think they're seeing the writing is on the wall as they're backed into a corner and they really don't have a choice. We are getting word that there is framework for a deal in place, another 3-year bailout, which will carry Greece fiscally through 2018, where they essentially will probably deal with the very same thing that we're dealing with right now. To me, it's not the best overall outcome. It is kicking the can down the road, but we have seen this before, and it will move Greece from the forefront of the news into the background for the next few years. All in all, we do not hold any exposure to Greece in our portfolios, and they are a very small country in terms of the size of their economy relative to the rest of the world. So we don't see them as somebody that's presenting a systemic risk to the global financial markets. As far as interest rates, we continue to hear the speculation about interest rates. You've heard me talk about it for many quarters now, as far as when the Federal Reserve will decide to raise interest rates. There was speculation it would happen in June. It has not happened. And a lot of those forecasts have been pushed off to either September or even December of this year. We maintain our position that we do not think the Federal Reserve will raise interest rates until we get into 2016. We still think there's a lot of fragile areas of the global economy, and with the U.S. being the largest central bank in the world, it's very important that we make sure the rest of the world is on board before we go ahead and lift that benchmark interest rate. But we'll continue to monitor the situation. If the economy shows itself to be a lot stronger than the data suggests right now, they could potentially raise rates sooner. So we'll continue to follow that, and we'll keep you updated as we move forward. Moving into the third quarter here, you will not see many changes to our portfolio. We still have the very same conviction we had last quarter, where we think that small U.S. domestic companies will outperform the broader market. We've already seen that year to date, with small cap indexes outperforming the larger, broader indexes by 4 to 5%. We think that will continue in the second part of the year. We continue to maintain our position in healthcare, as we have a very strong conviction that the emergence and the combination of Technology and healthcare coming together is creating a whole new sector in the world with new innovation, and we think that that can carry the markets higher in the long term for many years to come. So we will continue to keep that in the portfolio. And we still believe in technology. We still think technology is a place we want to invest. We will work that into the portfolio as well. But all in all, you will not see many changes from last quarter into this quarter. We did have one position that we removed towards the end of last quarter because it did have some international exposure. No specific exposure to Greece, but there was European exposure there, and we see that as some risk that we want to take off the table right now. So in quick recap, the portfolio looks very similar than it did last quarter, as we expect the small caps to continue to lead the markets and outperform the broader averages. As far as Greece is concerned, we do think that is in the rearview mirror at this point. We will continue to monitor the situation, but again, it appears that the European Union has kicked the can down the road at this time. Interest rates, keep an eye on interest rates. We think it'll probably be 2016 before they're increased, but it could happen in the later meetings for the Federal Reserve of this year. And lastly, we have seen the oil markets begin to stabilize. You've probably seen it if you've gone to the pump. The prices have come up a little bit. A lot of that is just normal, natural consumption that we see in the summer months here in the U.S., and we do usually see a rise in oil prices as supply ticks down. But all in all, we do think the markets will have a strong second half to the year. Now that we've got a lot of the external noise from Europe out of the way, we can get back to focusing on the U.S. fundamentals, earnings season, and the actual economic results of the companies that we're investing in, and we think that they're all in very good shape. If you have any questions about the things I discussed here in this video, I'd love to talk with you about it. Feel free to give me a call, send me an email, or give the office a call if you'd like to set up a meeting where we could sit down, go over the portfolio in more detail, and elaborate on some of the things I discussed here today. Again, thanks for watching, and we hope to see you soon.